So please come to the next important, very important discussion in option chapter, that is called real options. Student will ask me, what is the meaning of real option? In case of option, we have seen some time back financial options where the underlying is a stock, the underlying can be a bond, the underlying can be an index, but real option deal with not the financial asset, but real options deals with physical assets. That means there is an option where the underlying is not a financial asset or a financial instrument, but it is a real asset, physical asset. For example, we use this concept of real option in capital budgeting. We have a separate chapter, capital budgeting, where we are going to discuss once again in detail, but today as a continuation of this option topic, we will have some brief discussion on real option. Real option is on physical assets, like you have a project. After you start the project, you have two choices. You have an option to expand. The nature of the project may be such that you can exercise that option, and you have option do not expand. Option to expand in a project is a real option. The nature of the project is such that if you think it is successful, I might expand it later. So that option, if it is inbuilt into the project, that will call real option. Real option will make your NPV much higher than the project without the option, because if we have expansion option, I can check whether expansion will be more profitable or not, and it helps us to further add something to our NPV calculated without the option. Another example of real option is abandonment option. You may have solved questions of capital budgeting. The life of the project is 5 years and you have computed NPV for all the 5 years. But sometimes the project may have an option where you can terminate it before the maturity. So that project has this inbuilt option. In case if you don't want to continue, then you can terminate it before maturity, you can abandon it before maturity, and in that case it is possible that a project which may have negative NPV without abandonment option can have positive NPV with abandonment option, because you may sell it at a higher value at this point. So rather than continuing for 2 more years and getting a cash flow of 100, if you have an option to terminate the project and get 250 at this point, so probably this will be more beneficial to you than continuing with the project. So such option which allows you to abandon the project during the life of the project, you need not continue till the end, that is called abandonment option, and it is related to the project, it is called real option. You can start a project in our friendly country China, okay, for 5 years the project life, but you think that no, if I want I can abandon it also at whatever price I'll get. The project has an inbuilt abandonment option or real option. You can exercise that abandonment option and it may help you to increase your NPV. So no need to continue. The question is no need to continue till the end, but that option must be there in the project. In all your capital budgeting problems you have solved till now in your life, you have assumed that you are going to run the project till its entire life. With abandonment option, you need not run it till its entire life. You can terminate the project before maturity, get the salvage value which is offered to you, and that may increase your NPV. Another important option available in a project is timing option. Next year, suppose there is election. Suppose next year is election. And there are two possibilities. A good government will come to power or a bad government will come to power. What is good, what is bad is your definition, that if this party comes to power, it is good. If this comes to power, it is bad. And you think if this government comes to power, the price will go up. The price of the product you are manufacturing will go up, and therefore you can make more profit. But if this bad government comes to power, the price may go down. The price of the product you are manufacturing can go down, and therefore you might have losses. So what is better, now or after 1 year? Now or after 1 year? That is the question that I am going to answer. Okay, so you will compute NPV if you start the project now, or you can wait for a year, let the election get over, you will get more information. You will get information that yes, this party has come to power, so this is what the price would be, and therefore you are having more information to take a decision. If you start now, you have less information. So we are going to compute NPV if the project is started now, if the project is starting later, but this option is called timing option. Okay, this option is called timing option. As to when, you have an option when to start the project, now or after 1 year or after 2 years. Another example is an oil company. Company wants to construct an oil rig. The profitability depends on the price of the oil. The price of the oil today is let us say 100 rupees per liter. That is easy to understand. 100 rupees per liter. But there is a negotiation going on between oil producing countries. If that negotiation succeeds, the price may rise to 150. If the negotiation fails between those oil exporting countries, there is a big cartel called OPEC, Organization of Petroleum Exporting Countries, and they will come together, they will form a cartel, and they may reduce the output and increase the price. Then the price will be 150. But if the cartel members do not cooperate with each other, they fight with each other, the price can go down to 80. So what will you do? Will you start the construction of oil rig now? Then the expected selling price is 100, or will you wait for a year? After waiting for a year, you will get to know whether it is 150 or 80, and you can take a more informed decision. So timing option will increase your value of the project if that option is available. And there is a value of the option. There is a value of having such option in the project. The value of that option will be what NPV you will get with the option versus what NPV you would have got without the option. So you may be willing to pay some premium to hold this option, whether to start now or start later, whether to continue or shut down, whether to expand or not to expand. So such options are called real options, and they are also valued by using binomial model or risk neutral model or Black-Scholes model. So in this chapter we are going to study the valuation of real options using Black-Scholes model also and risk neutral model also. Real option methodology is an approach to capital budgeting that relies on option pricing theory to evaluate the project. So the knowledge of capital budgeting would be required here, some knowledge, but most knowledge that I am going to use is from option chapter only. Our role today will be to find the value of the option embedded in the project. Knowledge of capital budgeting is an additional advantage. Insights from option based analysis can improve estimate of project value. If you have the option, if you know how to value the option, that will help you to improve your NPV, and it can enhance the NPV of project management. Real option approach is intended to supplement and not replace capital budgeting analysis. The meaning of this line is that all the techniques of capital budgeting are useful, but if you also learn real option available in projects, that will further enhance or improve the NPV of the project. So it is not a substitute, rather it is complementary. It is an aid to capital budgeting exercise. First, you tick mark this theory question: how real option is different from financial option. How real option is different from financial option. Okay, how real option is different from financial option. So first is basis, second column underlying financial option, third column real option. In financial option, the underlying would be an asset which is traded on stock exchange, commodity exchange, bond market, like that, shares, stocks, bonds, commodity, etc. But in case of real options, the underlying is not something like share, bond, index or commodity. Here the underlying would be projects, capital budgeting projects, oil project, energy project, construction project, mining project, okay, which are not traded in any particular market. Second is payoff. In most of the financial option, the payoff is specified in the contract. The payoff is specified in the contract that this is the exercise price. If the price is more than or less than exercise price, what will you get? But in case of real option, it is estimated from the project cash flow. The value of the option will depend on the estimated cash flow the project would generate, and accordingly it can vary. One important difference is the exercise period. Financial options have shorter expiry period. Normally in India you will find financial option have an expiry of 3 months, 6 months, can go up to 1 year. Whereas in real option, the expiry period is very high. 1 year is very small here. It can go into several years. It can go to 5 years, 10 years. And what is the valuation approach? Because these options are traded in the market, they are priced by the market. Because they are easily traded in the market, there is a price of such option. We say option price, option premium price. Whereas in real option, they are not traded in the market. They are estimated. Based on the judgment of the valuer, they have to be valued. So real options are valued. Real options are valued, whereas financial options are priced. Next question is, what are the list of options that may exist in capital budgeting project? Another theory question. Give examples of options that can be included in a capital budgeting project. Long call. Long call means, as you have studied, buying a call option. But what do you mean by buying a call option in the context of real option? It means right to invest at some future date at certain price. Okay. Generally, any flexibility to invest or to enter into business to expand a business. I have given you examples for this long call. You start a project. and it may contain an option to further expand the capacity. It may contain an option to further expand the capacity. This is like holding a call option. This is like holding a call option, long call option, where in case if you want, you can make further investment. Or second example I had given you, option to start later. Let the election be over. Let the meeting of the oil producing companies be over. Thereafter we will see what is the outcome, and accordingly if I want I can invest later. That is called long call. Opposite of long call is long put. Example, option to abandon. Option to abandon. I did not continue with the project. I have an option to terminate it at some future date at some price. This is called long put. Long put means you can terminate the project before maturity date, either at some price or at some zero price. So generally it is opposite of long call. It is the flexibility to exit from a business. It is a flexibility to exit from a business. Then there is a short call. Have you studied short call? Short call means when you write a short call, you have an obligation to sell. Short call means obligation to sell. For those students who are interested, will write, short call is an obligation to sell. Obligation to sell means you have sold one right to another party who is a call option holder. You are a call option writer. If the other party wants, you will have the obligation to sell. That is what is meaning of short call. Promise to sell if the counterparty wants to buy. Generally any commitment to de-invest upon the action of another party. So here you have promised to other party, if he wants, I will sell the asset to him. If he wants, I will sell the asset to him. This is not a financial asset. It can be for example a software, for example a technology, for example any patent. I have given one example on the screen, you please note it down. If you don't have space in the book, maybe you can write in the notebook, no harm. Please write down chapter name, write down real options. Under that write down list of options. Then under that write down example of short call. Example of short call. Example of short call, write down a technology company has developed a cutting edge software application. A technology company has developed a cutting edge software application. The company sells the right, in bracket option, to another party to purchase an asset or project. That means asset means the software or project at a predetermined price within a specified time frame. So this will be an example of short call. You have an obligation to sell the software or the software project to another party at a predetermined price within a given time frame, only if the other party is willing to buy. If he is not willing to buy, option would lapse. The other party will evaluate his options on expiry date, and if he thinks it is profitable to exercise, then he will exercise. Okay, are you there? Have you noted down? Please confirm if you have noted it. If you have noted it, please write down yes. Very good. One more example, we'll take short put. Short put means obligation to buy. This meaning we have seen in option chapter also. In the context of real option, short put means obligation to buy. If the counterparty means the holder of the option wants to sell. In other words, it means it is a commitment to invest. It is a commitment to invest upon the action of another party. If the another party wants, then you have the obligation to invest in that project. Then it means you have written a put option. Example, write down. Write down the example in notebook. Examples will help you to understand better. Wherever examples are possible, we will write the example. Example, write down. A construction company offers the landholder a short put option. A construction company offers the landowner a short put option. This option grants the landowner the right to sell the land back to the construction company at a fixed price within a specified time period. So a construction company goes to a landowner and it says, I want to buy your land. The landowner says, sorry, I will not sell it now. Let me wait for a year. Okay. Then the construction company sells him this put option and he says, in case if you want to buy, if you want to sell your land, you can sell this land to me within 1 year. I am willing to purchase. So here the construction company has written a put option. If the landowner wants to sell his land, the construction company would be forced to buy that land. It means it has committed to invest in that land if the landowner wants to sell. So these are the various type of options, real options, which can be embedded into a project. And in all these 4 examples, it was not related to a financial asset. The underlying was not a financial asset. The underlying was a land or a software or an option to abandon the project, an option to delay the project, like that. So my next topic is valuation of real options. So these real options are also valued like financial options only. You will apply the same principles of valuation depending upon how the data is given. You can apply risk neutral model, binomial model, or Black and Scholes model. The only difficult part in real option is that certain inputs are difficult to arrive at. It becomes difficult to identify the value of certain inputs because here you are dealing with so many factors. In case of real option, the various types of cash flows associated with real option can be analyzed with cash flows involved in financial option, and method used in financial option can be employed easily. So just like financial option, we have real options. Here also we have exercise price, share price, something equivalent to share price, time, volatility, rate of interest. In real option, you have to see what constitutes the exercise price and what constitutes the share price. Okay, because that will not be directly given to you. The amount you are required to invest, that amount is called exercise price. Invest or disinvest, whatever. and share price, instead of share price, it will be present value of cash flows. Present value of cash flows will become the share price. Time remains the same, but this time the time can be in multiple years. It can be 2 years, 5 years, 10 years. So we'll take accordingly. Standard deviation has the same meaning, and the rate of interest has the same meaning. If you are using Black-Scholes model, the rate of interest you will take will be compounded continuously. Which are the models we can apply for valuation of real option? Without detailed discussion, again, one is binomial model, risk neutral model, Black-Scholes model. In the next few questions we are going to apply this Black-Scholes model, risk neutral model, binomial model. Next point is type of real options. Following are the broad types of real options. One is called growth option. Without option, NPV is negative, and the moment I add the option to abandon or expand or terminate or later project, the NPV may become positive. So sometimes we wonder why a project manager can go ahead with the negative NPV generating project. The reason is it may be generating negative NPV if we have not considered the option, but if we consider the option, the NPV may turn out to be positive, and therefore a project which has initially generated negative NPV can turn out to be a positive NPV project and can be accepted. So presence of option can enhance the NPV. Now read the note, you will understand. Sometimes it may be possible for some projects have a negative NPV. Even the managers may be interested in accepting the project, as it may enable companies to find considerable profitability and add value in future. That means the presence of the option can enhance the NPV of the project. This case of real option is like European call option. Example of growth option. Today it may not be profitable, but it may be profitable at a later stage. Like for example, investment in R&D activity may generate negative NPV, but with the option it may generate positive NPV. If it becomes successful, then you can get more revenue. Or same logic for advertisement. That means option can enhance the value, or initial investment in a foreign market to expand business in future. So go to China first. First you establish there, then you expand, and that will increase the value of your project. Then acquiring making rights, acquisition of vacant plot. So first you just buy a plot, wait for some time, see what is the market condition, and if the market price of the land or the apartments go up, you can develop in future and you can make a huge profit. So therefore investment now may generate a high return in future if there are options available, and that is why they are called growth option. Invest now, enjoy later. Study now, your study is also like a real growth option, enjoy later. And those students who are sleeping now, regret later. Keep this poem in mind. As a student of this course at this stage, this poem is applicable to you. Study now, enjoy later, sleep now, regret later. Did you like the poem? Those who liked the poem will say yes. And those who did not like the poem, everybody liked it. Okay. So you belong to this category who are studying now. The purpose of making such investment is that defining the competitive position of the firm, hence it is called strategic investment. Making investment today which will generate return in future are called strategic investment. It will give you a strategic position in the market. Like a student, more input you give right now, you will get more output at a later stage. If you start early, you will have more knowledge about that project's profitability. And then it also gives manufacturing and making flexibility to the firm. These are called real options, just for theory purpose. Now suddenly the student institute has asked you a question about this real option problem. Okay. So do you want to solve it today or tomorrow? Can we solve one question today? Yes. Can we solve? ABC Limited is a pharmaceutical company possessing a patent of a drug called Idrex, a medicine for AIDS patient. This will not affect my answer. Being an approach drug, ABC holds the right of production of drug and its marketing. The period of patent is 15 years, underline this first number we got, after which any other pharmaceutical company produce the drug with the same formula. So you will enjoy the benefit of the drug for 15 years. Every year gives you a value equal to 1 by 15. Total 15 year you will enjoy the benefit of that drug. So each year gives you the benefit which is equal to 1 by 15. It is estimated that companies shall require to incur 12.15 million for development and market of the drug. So this is like your exercise price. If you incur this expenditure, you will enjoy the benefit. As per the survey conducted, the expected present value of cash flow from the sale of the drug during the period of 15 years shall be 16.7 million. This is like your share price in the formula, 16.7. Present value of cash flow. Present value of cash flow during the period of 16 years will be 16.7 million. Cash flow from the previous similar type of drug have exhibited a variance of 26.8%. Sigma square is given 26.8% of the present value of the cash flow. The current yield on treasury bond of similar duration is 7.8%. This is 7.8% is R rate of interest. And in this question the time is 15 year. T is 15 year. Oh my God. Determine the value of the patent. What should be the value of the patent? So this is one method to compute the value of patent using Black and Scholes model. Time is given, rate is given, sigma is given, S is given, E is given. And this question has got one more component which is equivalent to dividend yield. And that is every year gives a benefit equal to 1 by 15. So dividend yield per annum will be 1 by 15 into 100. Dividend yield is equal to, it is like dividend equal 1 divided by 15%. So 6.67% would be treated as dividend yield. Every year generates a benefit of 6.67%. Every year generates a benefit of 6.67%. 6.67%. Because you can use the project for 15 years, so per year benefit you can generate is 6.67%. so that we will treat like a dividend yield. Okay, now the institute has given you some factor also. If required, use it. If not required, ignore. This is the natural log of 1.336. This is e to the power how much is that? We'll see later, we'll do ourselves. And this is e to the power again minus 117. So if required, use it, otherwise you know you can compute it yourself also. So first you write down a small note. Just 5 minutes. The given solution is like, the given situation is like valuation of stock option where delay in introduction of drug, name of the drug Adrex, shall cause the loss of cash flow, which is like payment of dividend. Every year you delay, you will lose 1/15 of the cash flow. Every year you delay, you will lose 1/15 of the cash flow, which is like payment of dividend. So if you start now, you will enjoy the income of all the 15 year. So which is like dividend yield in all the 15 year. To value the patent, we will use Black-Scholes model. We'll use Black-Scholes model because the problem has given you all the data that is required for Black-Scholes model. The problem has given you all the values which are required for Black-Scholes model. So first you write down inputs. In input, S is equal to spot price. Which is equal to PV of cash flow, which is equal to $16.7 million. E stands for exercise price. Which is equivalent to $12.5 million cost of development formula. 16.7 will be treated as S, 12.5 will be treated as E. Sigma square is 26.8%, which is variance of the cash flow. Please write down risk-free rate of return 7.8%, and dividend yield every year is worth 6.7%. So expected cost of delay is 1/15. The expected cost of delay is 1/15, which is like dividend yield. So right here, this is like, don't miss this question. This is very important, never asked earlier in the exam. This is like a dividend yield, 6.7%. So all these are per annum. This is interest rate is per annum, dividend yield is 6.7% per annum. Okay, now whenever the dividend yield is given, the student will remember the spot price is adjusted. By dividing the spot price by e to the power rt. I hope you remember in the previous lecture only on the option valuation model we have discussed it. So adjusted S is equal to adjusted S whenever dividend yield is there, that 1 by 15 the cost of delay is equivalent to dividend yield, S upon e to the power yt. 16.7 is the spot price and e to the power dividend yield is 6.67%, 0.0667 into 15 into 15. You first simplify that. When you simplify this, finally you will get this answer. The student has to check. The student will have to check. Nothing can be done. You have to do it. Otherwise, let me check whether institute has given some value for that. So this answer should be around 6.14. This should be 6.14. Please check. 6.14. 6.14. Now write down step 2. Natural log of S upon E. Natural log of 6.14 by 12.5. Natural log of 0.4912. Natural log of 0.4912. I am going to use adjusted spot price in all calculation now. So that is 0.4912, which you can write as log with base 10. Log with base 10 0.4912 upon log with base 10 E. I hope you are doing. How to calculate this answer? Type 0.4912, press square root 12 times, minus 1 multiplied by 1778.37. You will get some number. Write it here. Log 10 base E is always 0.4343. Log of E with base 10 is 0.4343. So write this number, divide by 0.4343. Please confirm. You are getting minus 0.7106. Yes, very good. Minus this number. Everybody got it? Please confirm final answer. Okay, now we'll go to step number 4, D1. Write the formula. Write the formula. This we have computed in previous step. Write the formula. One more practice on Black-Scholes model under real options. After writing the formula, put the values. Put the values. 0.7106 negative. This is from previous step 3. This is from previous step. Interest rate is 7.8% plus sigma square is 0.268 by 2 into number of years 15. This is the square root of 0.268. Can you take on your calculator square root of 0.268? You will get this answer. Into under root 15. Solve. Please solve. Please solve. Anybody, any answer? 1.2316. 1.2316. Just confirm 1.2316 is right. 1.2316 is right. Yes. Now understand, wait for a second. Look at the institute formula. What institute has done? Look at your book. Institute have not adjusted this part. Institute have adjusted R. In institute answer, they have taken natural log of 16.7 divided by 12.5, but from R value 0.078 they have reduced the dividend yield, whereas we have adjusted the share price. Finally, if you compare our answer 1.2316 with institute answer 1.2315, this is same. So student can either follow this formula which we have used in option chapter also, or the student can follow institute formula for D1. You will get same answer. Choice is yours. I have given you both the way of getting the answer. Now write down D2. D2 equal to D1 minus sigma under root T. 1.2136, this number, minus this number. So this time the answer is minus 0.7734. Minus 0.7734. So these are my D1 and D2. So this is equivalent to 1.23, say, and this is equal to say 0.77. See, the institute has not given in the original question the value of ND1 and ND2. They have not given you the normal distribution table also. So what we will do, we will have to apply our own normal distribution table. Do you have normal distribution table? Do you have normal distribution table? If yes, please check the value of 1.23 and 0.77. Write down below. Step number 6. ND1 equal to N 1.2316 and 1.2316. N is positive. D1 is positive. If D1 is positive, we have to take 1.26. 1.26. So this is 1.2 here. This is 1.2 here. 0, 1, 2, 3, 4, 5, 6. This is 1.26. 0.39617. And for 0.77, this is 0.7, 0, 1, 2, 3, 4, 5, 6, 7. 0.27935. If the table is not given in the problem, then normal distribution table will be used. But right now I can't help it. Institute has not given any factor. Okay. So you have seen this factor here in your normal table. Because D1 is positive, we'll add 0.5. If D1 is positive, we have to find this area. This is given by the table. This is 0.5. Table value plus 0.5. If the area between mean and D1 is given. Now try the next one. ND2, this is negative. So D2 is negative. I want the area of this side. This is the table value 0.27935. You can refer your normal distribution table. Total area is 0.5 on the left side of the mean minus 0.27935 minus 0.27935. So the answer is 0.22065. 0.22065. Institute answer is very close to our answer. If I take this is 0.89, institute answer is 0.8910. If I look at this answer, our answer is 0.220, institute answer is 0.2196. 0.219 is equal to 0.22. Okay, so not major difference, some difference because of the rounding off. Now we'll compute PV factor. 1 divided by e to the power RT. 1 divided by 2.7183 to the power 0.078 into 15. 0.078 into 15. 0.078 into 15. Solve. Check the answer. If you see the institute answer, this factor is given in the problem. This factor is given in the problem. 0.3104. 0.3104 is given in the question also, which is e to the power 1.17. Negative means directly present value factor is given. Now we will write down the last step. Value of call option. Value of call option. Call option here means you can exercise your option at any time during the next 15 years. Solve it please. Solve it please. Give me the final answer. Give me the final answer. Value of call option into bracket value of patent. Now the answer is, check the answer, 4.61. If you look at the institute answer also, finally the institute answer is also the same. We have just changed some calculation presentation. Logic is same. If the logic is same, the answer will also be same. $4.61 million. Okay. Is this answer clear now? So now we'll continue tomorrow. Thank you very much for joining me today.